Hi everyone, welcome back to the discussion on this topic, which is Ind AS 33, which is earnings per share. Friends, we have discussed these aspects of the basic EPS calculation and the relevance of that, right? And we also discussed, of course, how do we measure the basic EPS under different scenarios, specifically focusing on the right offer, and of course the other aspects, including the bonus and the stock split, where we said that we want to go retrospective. Okay. Essentially, what we want to now talk about is something which is not about the current EPS or a basic EPS, but something about the future EPS. Okay. We all understand that any shareholder or any investor would want to take a decision or an investment decision, taking into mind the future growth of that investment. All right. And we talked about it, of course, when you look at earnings per share, it's a measure of return. Okay. So if you invest your money today, basis on the EPS or the earnings per share that the company has earned today, you also would like to assess in which direction is that EPS going to be in future. Is it going to increase or is it going to decrease in future? And that is the reason why the context of diluted EPS, or this is where the context of diluted EPS comes into the picture, right? What that shareholder least expects, that he sees a good or a favorable EPS today that may decline in future due to some circumstances, all right, that have already taken place. Okay, so the shareholder or the investor or the proposed investor needs to be given that information that today, if the EPS is strong, is there a likelihood that this EPS can decline in future? Can there be a dilution in that EPS in future? And that is what is the context of a diluted earnings per share or a diluted EPS, right? So we would need to address that part in this discussion. We're saying that entities often enter into commitment to issue shares in future, which can very well change the EPS. I mean, the whole idea is that the denominator, which is the weighted average number of shares or the number of shares, right? In that context, if they increase, then automatically the EPS would decline. Okay. So we are referring to something called as, it's not a share today, but it has a potential to become a share in future. All right. It's not a share today. That instrument is not a share today, but it has a potential to become a share in future. And we use the term called as a potential share. Okay. A common example could be a convertible bond or a convertible debt. Okay. Or it could be, for example, a share warrant, or it could be an option, right? So any such instruments which are not shares today, but they can become, or they may become a share in future, that could impact the EPS of future. And that is what would concern, the potential investor or the shareholder. And this information, in case that EPS dilutes or is expected to dilute in future, that information has to be provided in the books today itself. All right. So we're saying because the number of shares in issue will change, and accordingly the dilution can arise, right? Of course, we also address the aspect that in case there were a convertible bond or it's a convertible debenture today, you are very likely incurring some interest costs. And of course, in case that debenture, right, becomes a share tomorrow, that interest is not applicable. The interest cost or the interest expense would not apply. So naturally, there is also a consequence likely to arise on the profitability, and that is your numerator, right? And of course, we refer to that number of shares as your denominator here. Okay, so you bring these aspects into consideration when you are measuring what is the potential impact or what is the impact likely to arise in future on the current EPS or the basic EPS, right? So the examples of such instruments could be financial liabilities or equity instruments, including preference shares that are convertible, okay? Options and warrants, and there are specific, standards. For example, Ind AS 32, which talks about the presentation and classification aspects of financial instruments, or Ind AS 102, which talks about share-based payments. That's where it is addressed. Similarly, there could be shares that could be issued on some satisfaction of some conditions. For example, you're acquiring a business or you intend to acquire a business, and you might as well issue shares in lieu of that. That can again increase the number of shares in future. So effectively, look at all these aspects, there is a potential dilution in place, right? How do we address that, right? Let's look at a very basic, very fundamental example of how this dilution is assessed or measured, and then we can appreciate the requirement of the standard in that context. All right, let's say there is a company X, okay, or this company XY, okay. It has, for example, just trying to build a small, statement of profit or loss. Let's say there is a revenue of 1 lakh. There is a cost of goods sold of 60,000. That gives a gross profit of 40,000, right? There are operational expenses of, let's say, 15,000. All right, that gives an EBIT, earnings before interest and tax, of 25,000. And let's say there is an interest expense, which is on bonds of rupees 1 lakh at, let's say, 10%, right? So that becomes, of course, 10,000. That gives an EBT, or earning before tax, of 15,000. And let's say the tax we measure at 30%, right? Now this would be 4,500, and my profit after tax or earnings after tax would be 10,500. This is a normal, statement of profit or loss. So this is the profit which is available to ordinary. This is the profit which is available to ordinary shareholders, right? But then assume that this is a convertible bond. Okay. Let's also assume, by the way, the number of shares that this entity XY has currently is 1 lakh. Okay. So with the current scenario, with the total earnings of 10,500, we can calculate the EPS, which is 10,500 divided by 1 lakh. That would be 0.105, right? This is clearly the basic EPS as we would normally calculate that. Okay. And now, as we were referring to, let's say that these bonds are convertible bonds at the discretion of the entity or the discretion of the holder, the discretion of the issuer or the discretion of the holder. These bonds may be converted in future. Nobody knows at this point in time whether the conversion will take place or not. But what if the conversion is expected to take place, right? The moment we say the conversion would happen, there are two consequences of that. One, you will not pay interest because now it's not a bond anymore. It becomes a share, right? And also, the number of shares would not remain the same because the number of shares will increase. Okay, so let's assume, for the sake of argument, that the conversion has taken place. How would that impact the EPS is something that we want to try. Okay, now let's say if these were converted, so post conversion aspect, the revenue doesn't change because the money is not coming or going anywhere, right? So up to, for that matter, EBIT, everything remains the same, right? But now, since you are not paying any interest, your earning before tax is the same as your earning before interest and tax, which is 25,000. Now, tax at 30% on this amount will be 7,500. Okay, that means your profit available to ordinary shareholders has increased from 10,500. It has become 17,500, right? But what is your number of shares outstanding is what you need to consider. Okay, say for the sake of argument, as we had 1 lakh rupees worth of bonds which get converted into shares, let us say the conversion suggests that the entire bonds get converted into, let's say, 50,000 shares, right? The moment this conversion happens, or if this conversion were to happen, my number of shares outstanding will be 1 lakh existing and 50,000 additional shares, which makes it 1,50,000 shares. And now your revised EPS, assuming that the conversion has taken place, will be 17,500 divided by 1,50,000. All right. So that becomes 0.117. Okay. Now, what you observe here, that your original EPS was 0.105. Okay. Right. But with this conversion taking place, it has increased, which is 0.117. There's no problem with that, right? Effectively, the conversion is resulting into, an increase in the, let's say, the earnings per share, which is fine. But let us say, for the sake of argument, these bonds had converted into, instead of 50,000 shares, these would have converted into 1,50,000 shares. Now, what is the consequence? The total number of shares outstanding would have been 2,50,000. And now, if I were to calculate the EPS, okay, that would be 0.070. Okay, so what you observe is, and this is all contextual, this is all theoretical, right? But that is something which is the, the requirement of the standard. It says that compare your basic EPS as a normal EPS with the consequence or impact of those potential shares, like a convertible bond in this example. What if those potential shares are or were converted into shares today, right? Whether it happens or not is not important, not at this stage of, or not at this point in time. What is critical is that if this were to happen in future, right? What is the, how would the EPS look like, right? If it reduces, if this revised EPS is less than the original basic EPS, we refer this to as a diluted EPS. We say that there is a dilution in the current earnings per share, and that needs to be reported separately. So you in any case report the basic EPS, but you're now also required to report the diluted EPS on the face of your profit and loss account. Okay, that's the reason why we need to understand the consequences. You need to tell the shareholders or the potential investors that, look, this is what is my current EPS, but don't just look at that. You also look at the dilution side of that. And accordingly, be, careful about making your decision about investing in the company or otherwise. Okay, so that's a concept that we have briefly talked about with the help of numbers. Let's have a look at some more concepts within the, within the structure of diluted EPS in a more detailed manner. We are saying that for the purpose of calculating diluted EPS, you adjust the profit or loss as attributable to the ordinary shareholders of the parent entity, as we have just done that, and also the weighted average number of shares outstanding for the impact of all dilutions, right? That's what you're supposed to do. And that is where you start looking at it. What is your original profit plus the impact of, the profit impact on the profitability because of the dilution, assuming that those potential shares have become shares now, which means if it were a bond, we would remove, for example, the interest portion and the relevant tax consequence. We just did that in the example. If it were a preference share, right, a preference share may be convertible into ordinary share also. So you would take into the consequence the dividend part of that, right? So you bring all these changes in, for example, let's say the profitability level at the numerator level, right? And similarly, you would change the denominator with respect to these dilution. Okay, that's something that you want to take into consideration. Now it's provided as a small example. It says that Tom Limited has issued optionally convertible preference shares to convert these into equal number of ordinary shares in 4 years from now. Now, these are again potential shares, potential ordinary equity shares. We don't know whether the conversion will happen. It all depends what is the market price, etc., whether it is favorable to the user if he has an option, or the holder if he has an option, or whether it is favorable to the entity if it has an option either, right? So from that perspective, you as a company are making an assumption that the conversion would take place either at the start of the period or the date of the issue, whichever is later. Okay, and accordingly, these shares are only treated as diluted if they are expected to decrease the profit per share. That's something we are talking about. You're referring to the basic EPS. If it is likely to go down, then we call these potential shares having a dilutive impact. Okay, right? As we said before, the earnings need to be adjusted from the context of that you're not going to pay any interest, you're not going to pay any dividends, tax consequences will have to be managed as well. So all those aspects are to be made for the net tax or the post-tax impacts, right? Similarly, any interest recognized, etc., have to be also brought into the consideration. The example that we did a while ago is a classic scenario where you start looking at understanding the practical implication of measuring the diluted EPS. Right? We still have a few more examples to discuss this aspect in detail. Right? Now here we go. It says that Jerry Limited has an issue 50,000 8% debentures at a nominal value of 2 rupees per debenture. Now, these are converted into ordinary shares in the ratio of 1:1 at any time until March 2020. The management receives a bonus based on 2% of profit before tax. Jerry Limited's result for 2017 show a profit before tax of 1,60,000 and a profit after tax of 1,28,000. So tax consequences at 20%. The question is, you're required to calculate the earnings for the purposes of diluted EPS. Okay, so we have provided, of course, the profit before tax is 1,60,000 and the profit after tax is 1,28,000. Essentially, the profit which is relevant for us is 1,28,000. Okay, so we need to look at it whether this profit is increasing or decreasing. That is where we start looking at the context. We're not given any information in terms of what are the existing number of shares. So let's not go there, right? What is important is what is the impact on the profitability. That's what we need to bring along. Okay, so let's take these figures. We are saying that the current profit after tax, which is 1,28,000, had this conversion taken place, okay, if this conversion had taken place, we are saying there are 50,000 debentures of 2 rupees value being paid an interest of 8%. What does it mean? If the conversion takes place, simply you save the interest expenses, which is 50,000 into 2 into 8%, right? That becomes 8,000. But since you saved the interest expenses, you also would pay the extra tax on that, which is 8,000 into 20%. So the post-tax consequence is 6,400 if you were to combine these two values. Okay, that's one side of the, the one leg of the, or one consequence of this particular change if those bonds or debentures were converted into shares. Also, it is provided the company's management receives a bonus on 2% of PBT. Now, the moment we say that 8,000 rupees is saved on the interest cost, your PBT increases to that extent, right? Your profit before tax increases to the extent of 8,000. So on this 8,000, you are supposed to now pay 2% of the bonus. So we are saying that the bonus impact shall be 8,000 into 2%, which makes it 160. So you would land up paying more. So it has to be a negative figure. But on that bonus, you would again have a tax saving at the rate of 20%, which is 160 into 20%, which makes it 32, right? So this amount, whatever we calculate, let's do that calculation quickly. 1,288,000 plus 6,400 plus 32 minus 160. So the profit, which is the relevant profit for the calculation of diluted EPS, profit relevant for diluted EPS measurement should be or will be 1,34,272. Okay, let's have a look at the formal solution. We're saying that for the purpose of calculating diluted EPS, the earnings should be adjusted for the reduction in interest charges, net of taxes, and for the increase in the bonus payment, net of taxes. So this is what we have done. And all those numbers result in the final earnings for the purposes of diluted EPS at 1,34,272, right? Importantly, we have not split that convertible debenture into liability and equity portion. It's a very simple scenario given. So, and there's no other information available in the question also. So that's a way we have, moved ahead. That's the way we have gone into the discussions around that. Okay. We have discussed this again. Importantly, adjustments for the effects of all potentially shares to be made with respect to the profit or loss, and of course, the weighted average number of shares outstanding. And that is where you start looking at whatever were your original number of shares, you would also make an impact, or you would also add what are the additional number of shares because of that potential shares becoming ordinary shares, right? That's what you're supposed to, of course, do further. Okay, let's have a look at a small example here. It says that Mickey Limited has 5 lakh ordinary equity shares of ₹2 each and 500 10% convertible debentures of ₹200. Each debenture is convertible into 40 ordinary shares. Now, importantly, we have 500 debentures. And if these were converted into shares, we are actually talking about 20,000 additional shares, right? So as you as you read the statement, okay, as you read this statement, you are able to kind of bear in mind that this is the calculation that I need to be looking at. It says that Mickey Limited share price is 4.5 rupees and earnings for the period are 5 lakh rupees. The tax rate as applicable to entity is 21%. The question says you're required to calculate the basic and diluted EPS and earnings per incremental share for the convertible debenture. Okay. Now, there are three parts. One is calculation of basic EPS. Second is the diluted EPS. And it says, what is your earning per incremental? So there are 20,000 incremental shares issued. So what is that? Earnings per incremental share. We are supposed to calculate that as well. So let's do this together. Okay. We are given 5 lakh shares. We're also given the profit is 5 lakh. All right. And the tax rate is 21%. So effectively, if I were to calculate my basic EPS, I'm referring to the earnings for the year, which is 5 lakh. Number of shares outstanding is also 5 lakh. All right. Which actually means that my basic EPS can be comfortably calculated at 5 lakhs divided by 5 lakhs. That becomes ₹1 per share. Okay. And the moment we refer to the diluted EPS, we are saying profit for the year, which is of course 5 lakh rupees. Okay. And then we are looking at, of course, the saving of interest. Now we have 500 debentures of 200 each, on which you are paying a 10% interest, right? That makes it, of course, 10,000, right? So effectively, on 1 lakh worth of shares, we are paying an interest of 10,000, which means that we're looking at interest saving, which is 10,000. That will increase your original profit, but there would be, of course, tax impact at 21%, which means that you're going to pay extra tax because of the interest saving, which means that your revised profit, right, which is the profit for calculating the diluted EPS is 5,07,900. Okay. Now, we are now talking about, of course, the number of shares assuming conversion, right? We originally had 5 lakh shares. The additional number of shares are 20,000. So that makes it 5,20,000. And simply the revised EPS would be 5,07,900 divided by 5,20,000. That gives 0.977. That's the approximate number that we're looking at. Of course, the original EPS was 1 rupee a share, and the revised EPS is less than that. So this becomes the diluted EPS for us. Okay. Of course, there was one more requirement. We were supposed to calculate the the incremental earnings per share. So we're looking at what is the incremental profit. That is, of course, 7,900. And then looking at incremental number of shares, which is 20,000. That gives 0.395. That's where you start looking at the calculation of that part, right? It is not relevant to use it within in the calculation of diluted EPS, but a factor of less than 1 would normally indicate that there's a dilution impact of the potential shares being converted into ordinary shares. Okay, let's have a look at the formal solution as well. It says that the basic EPS is 1 rupee per share. We did that. Calculation of earnings effect for convertible debentures is basically whatever is your number of debentures, which was 500, nominal value was 200, interest cost was 10%, and of course the net of taxes, it would be coming at 7,900. We did that calculation of 10,000 minus 2,100. So that's 7,900, of course. And finally, we are looking at 20,000 shares, and the earnings per incremental share is 0.395, which suggests, because it is less than 1, likely it is falling in the dilution. And the diluted EPS is calculated at the revised profit, taking those interest saving net of taxes divided by the total number of shares assuming conversion. So that becomes 0.977. All right. Thank you very much.